Hello everyone, welcome to today's US Open live webinar. It is Thursday, November 2nd. I'm your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. What a week it is. The Bank of Japan kicked off the central bank bonanza and the Fed follow yesterday with a dovish hold that led to a relief rally in bond and stock markets, while the US dollar declines. Today, it was the Bank of England's turn to take the spotlight, which also stood pat on rates despite raising its inflation outlook for the next 2 years. We also had a high-profile earnings, such as those of AMD, the rival of the AI leader NVIDIA. And of course, Apple is highly anticipated after the close, and there are many high impact events yet to come tomorrow and at the beginning of the next week. That is what we will be talking about today. Before, however, we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Let's give it a few more seconds and then we will begin. Okay, let's get the ball rolling because we have many things and significant things to talk about. We're going to start with the Bank of England and the GBP USD analysis. We already see the chart on our screen. Then we're going to talk about yesterday's Fed dovish hold and how Euro USD reacted. And then we're going to move to the Nasdaq, which also benefited from the Fed's outcome. Then we're going to talk about AMD, the chip designer that tries to enter into the AI arena and challenge NVIDIA's dominance. And we're then going to talk about what's ahead, which includes Apple's incoming earnings today after market close, tomorrow's US NFPs, and of course, Tuesdays before our next session, Tuesday's pivotal decision by the Reserve Bank of Australia. So the Bank of England kept rates unchanged at 5.25% earlier today for second consecutive meeting, with 3 of the 9 members dissenting in favor of a hike. So we still see divisions there as always. Inflation has come down, and that is what has allowed the bank to stay on the sidelines. And officials expect it to continue to fall sharply and below 5% this year. But on the other hand, the bank raised forecasts for next year and pushed back the timing of hitting the 2% target. CPI, according to today's updated projections, will fall below 2% in Q4 of 2025 compared to previous forecast for the second quarter of 2025. So there seems to be a little bit of wishful thinking there in my mind. But of course, the central bank also has many reasons to stop here. And an interesting fact is that those updated projections that we referenced are conditioned on rates peaking at basically current levels at 5.3%. So that's another indication that the bank may have reached the terminal rate. Of course, some of these factors why officials would want to stop is increased borrowing costs and, of course, economic stagnation. And in fact, the bank downgraded its 2024 GDP forecast to flat, no growth, stagnation. Now, GBP USD initially reacted positively to the hold, and it seems like the ECB could stay at current level, so there was a positive reaction there. And let's turn to the 4-hour chart for our analysis. And now has a chance to surpass the 200 days the 200 period EMA, the black line, and pose its bearish bias. However, we already see that this initial boost wanes, and technically the British pound has a tough road ahead. There is also the 200 days EMA, the blue line that you see higher on the chart, and the 38.2% Fibonacci of the drop from the 2023 highs, and a thick falling daily Ichimoku cloud. So definitely we're cautious still about the ascending prospects, and we still need to see how today's decision from the BoE will play out, since it's less than a couple of hours since it was announced. At this time, bearish bias is intact, and as long as we remain below the black line on the chart, and the pair is in risk of moving below the October low, 1.2036, although that of the year at 1.1801 looks distant for now. Let's move now to the euro versus the greenback and talk about the Fed, which held rates on Wednesday for second meeting in a row, and its rhetoric was dovish, shifting away from the previous hawkish bias. Mr. Powell said that the risks of over tightening versus doing too little have gotten more two-sided. That was one indication of this dovish shift. Most importantly, though, he refrained from reiterating the belief that the policy is not sufficiently restrictive to achieve price stability. That's a striking shift from what he had said in September and just a couple of weeks back at the Economic Club of New York. Back then, he had said that policy is not sufficiently restrictive. Now, Euro USD rose as a result. You can see it tries again to surpass these critical tech levels that we have been talking about for quite a few days now and in previous sessions, and try to extend it and test the other critical region of 1.073, 0.763. Of course, it had failed multiple times to do that, and the upside is definitely unhospitable. And of course, the ECB last week had also paused after 10 consecutive hikes, and although it did not shut the door to more tightening, it did so again an inclination to stop here at current levels. Of course, inflation dropped to the lowest in 2 years, according to this week's preliminary results, so that definitely helps officials stay on the sidelines. And preliminary data around GDP growth showed a contraction in Q3. Again, these were this week's data, so a tough road here as well. We have seen signs of the limitations of the USD strength, but it's early to talk about a reversal in both those pairs that we examined. So it will be interesting to see how things go from here. And now let's turn our attention to the Nasdaq, which rallies today due to the Fed's dovish hold, which we just covered, and of course the drop in yields, and the index now yesterday posted its best day since summer. It extends those gains today, reclaims the 200 period EMA, and that allows it to regain the initiative and push for new 2023 highs located at 15,346. However, we are still a bit cautious. There seems to be some exuberance for now, but again, this also may be a little bit stretched. And there are also key events ahead that could determine the next leg. The Fed, on the other hand, kept more tightening in play, and that's why I say maybe this exuberance is a bit stretched. And technically, the move is definitely stretched. You can see how it has reached overbought conditions based on the RSI at the bottom of your screen. So there is still risk of renewed pressure, but sustained weakness does not look easy, and a test of the 38.2% Fibonacci at around 13,842 seems like a tall order at this stage, given the Fed's dovish tilt and generally good results so far from, mostly good results so far from tech giants. One of those tech companies, of course, was AMD, the chip designer, which returned to revenue growth in the third quarter, according to Tuesday's results, and expects an acceleration in the fourth quarter to 9% year over year, in excess of 6 billion. In that quarter, executives expect to start seeing the impact of their artificial intelligence chips. It launched recently new data center chips to compete with NVIDIA. NVIDIA, of course, is the leader and the enabler of the AI revolution, which has already seen the benefits of this early work in its financials and its stock price. Now, back to NVIDIA, the CEO expects the data center GPU to generate 400 million in the current quarter and exceed 2 billion in 2024, based on the rapid AI progress. So there are hopes that it will monetize starting from this quarter on its AI work. Despite losses in yesterday's pre-market, AMD rallied on Wednesday after the results with the best day since May. It gained around nearly 10%. And of course, it was held by the broader rally on the Fed's dovish hold and returned above the 200 period EMA. This gives it the potential to push for new 2023 highs at 132.72. On the other hand, AMD is still behind on the AI race. It will now step into that arena essentially, and NVIDIA will likely remain untouchable for quite a long time. So AMD will be probably playing for second position at best. The stock of AMD remains in a precarious position after 3 straight losing months, but strong catalyst would probably be needed for a drop below the 80.89 support level. Now let's turn our attention to Apple. The tech giant releases its earnings today after market close. We already touched on it in our last session, but let's reiterate a few things and also talk a little bit about the tough stock, the tough spot in which the stock is, although it tries to change that, as you can see. So Apple comes from 3 straight quarters of negative growth, does not expect that to change with Tuesday's results based on its own guidance. iPhone sales have sagged against weak demand globally. It's of course the main revenue driver. There are also concerns around its reliance on China for sales and production, given the strained Sino-Western relations. And another thing is that we don't know much about what its generative AI plans are. It's been tight-lipped. If it stays behind, it may have issues down the road. If it manages to incorporate that technology into its products, and given, of course, its vast number of clients, then that can unlock value for the company. Technically, as we said, it is in a tough spot with a series of lower lows, as you can see here on the daily chart, and a breach of the 38.2% Fibonacci of the 2020 low, 2023 high rally, which creates risk for further losses towards 105 to the 6.1% Fibonacci. However, the stock manages to rebound, and the results will be critical. Above the 200 period EMA, where it is today, it's opened lower again today, a 5th straight profitable day so far, again boosted by the broader improvement in sentiment. So it has the chance to push higher and back towards the record highs it had set in July at nearly $200 per share, but there are roadblocks, starting of course with the daily Ichimoku cloud that you see. It's going to have to pierce through that. Of course, next week is very busy in terms of earnings, starting with Ryanair, the Irish European carrier, which will also be closely watched, and more to come. We will discuss that about that next week. Now I'm going to turn back to GBP USD to see how it progresses. It stabilizes after the initial boost, but I want to talk about other key upcoming events. We have the US jobs report on Friday. The Fed said yesterday that supply and demand conditions continue to come into better balance, but the labor market remains tight. The last report had shown the addition of 336K jobs in September, marking the biggest gain since the start of the year. So this will be closely watched and will be taken into account by the Fed at a period where officials go meeting by meeting and tout the data dependence as monetary policies in an intricate phase. And we also expect the Reserve Bank of Australia on Tuesday. It had stayed on the sideline over the past 4 meetings, but the accounts of the last decision showed readiness to act if needed. Governor Bullock warned last week that the return of inflation to the 2-3% target could be slower than projected. The consumer price index has been falling over the past 3 quarters, but it is still far from target at 5.4%, while the monthly measure rose to 5.6% year over year in September, and the highest since April. So there is some persistence there. The International Monetary Fund on Tuesday recommended further monetary policy tightening, and the ASX RBA rate indicator prices in a 52% of a hike. So the meeting is live. Of course, those high expectations leave a room for disappointment if policymakers hesitate to pull the trigger. So that is pretty much it from me for today. As we said, still key events ahead tomorrow and of course over the next week, and Apple reporting after today's close. That's it from me. Thank you for joining me.